Let's just have a look at the trade data and start there, the relevance for the South African economy, looking at that surplus of some 2 billion rand for the month of July.
Yes, Bronwyn, if you look at the surplus of 2 billion, I think it's quite surprising because it comes on quite a big surplus also the previous month. What it does suggest is if we look at the current account prospects for this year, it's probably slightly better than what we thought previously, but we'll probably still have a sizable deficit of the order of about 100 billion or slightly more than that for the year as a whole. The trade data for the first 7 months of this year, however, does suggest that if you look at domestic spending, spending continued to pick up into the third quarter of this year. And on the export side, we still have quite reasonable growth in exports as well. So foreign trade activity is picking up, and we believe that is positive for the local economy.
And then, Dave, just looking at the credit growth, up 2% year on year for the month of July. That was above expectations. The market was expecting a number closer to 1.45%. Again, this is starting to show some traction in both the corporate and the retail consumer in South Africa.
Absolutely. If we look at the credit numbers for the balance of this year, it's been creeping up. We're now getting to levels, if we look at household credit, extension that is going above the inflation rate, so we've got some real growth in credit being extended at least to the households at this stage. This is the usual part of the cycle. The households tend to lead it, and then the corporates will follow. If we look at the corporates, as you mentioned, also some signs of life there, and again we take this as an indicator that going into the third quarter this economy was still probably in a recovery mode.
Dave, without giving away any state secrets, being Chief Investment Officer at Citadel, can you give us your thoughts on the market at the moment and broad strokes in terms of what you are playing at?
If we look at markets, first of all, we're not very impressed with where government bond yields are. If we look at bond yields, it's certainly internationally and increasingly locally as well, they're not at attractive levels. The same goes for cash internationally. Locally, slightly better rates in terms of cash, but if you pay tax, not much better than the going inflation rate. If we look at the credit numbers and some of the growth numbers that have come out, we might even see a further cut in short-term interest rates, in the balance of this year. So we really don't look to the interest markets, as being attractive. However, if we look at equities, certainly internationally and locally, if we assume an ongoing economic recovery, companies going back to fair margins, not the kind of margins or profit margins that we saw in 2006 and 2007, but just average company margins, we believe equities, locally and internationally, probably present the most exciting return potential.
Let's just pick up on that theme, the international equity exposure. Are you starting to pick up in that regard? Do you advocate in favor of investors doing that in the medium term, where they're getting better value from international equities than from perhaps even South African equities?
That would certainly be the case. If we look at international equities, the expected returns are slightly better. If we look at normalized PEs, therefore looking at current prices relative to what a normal profit level would be for companies, it also comes up to be more attractive internationally than locally. So at Citadel, what we recommend is that in terms of your equity portfolio, you would be overweight international equities relative to local equities.
Do you subscribe to the double dip recession, or I suppose with that relatively bullish view on equities, you don't?
No, I think if we look at the US economy, for example, over the last 80 years, we've only had two double dips. The one in 1937, when Roosevelt tightened fiscal policy too much, having thought that they've pulled out of the Great Depression. And then secondly, in 1981-82, Paul Volcker hitting the economy over the head by doubling interest rates again to get inflation under control. So in both of those cases, the one was a policy mistake, underestimating the weakness of the economy, the strength of the economy, and secondly, a deliberate policy decision to weaken the economy to get inflation under control. Where we stand today, we believe, certainly in the US, authorities guard against the specter of deflation, therefore they won't make the policy mistake pushing the economy back into an economic recession. Secondly, also, if you look at how your cyclical sectors have adjusted over the last 3-4 years in the US, if we look at housing starts, they're back to levels we haven't seen since the 1950s. And if you look at car sales, for example, they're back to levels of decades ago. And those are the two sectors that typically push you into a double dip or into an economic recession. And we think the downside from these levels where we are currently is not that much in those critically important sectors when you look at a double dip. So we are optimistic that there might be some growth slowdown, but not necessarily a double dip in the US.
Coming back to the local front, earlier in our conversation, Dave, you mentioned that you expect short-term interest rates to come down. Are you calling for 50 basis points cut at the 9th of September MPC meeting? And then added to that, what are your views for the November decision on South African interest rates?
I think if we look at interest rates, there is certainly, if you look at inflation, probably the scope to cut rates. But if we look at the growth numbers and the credit numbers we mentioned earlier, we've got to be careful that we don't make the mistake we made, in the previous cycle by cutting interest rates too far and too late into the cycle. So that would be at the back of the minds of the bank's Monetary Policy Committee when they meet. The other thing in the short run that could prevent a cut in rates is we're now in a season where it looks like everybody wants a wage increase of the order of 8.5% to 12.5% or even 15%. And I think the bank needs to demonstrate that they will act tough in terms of inflation to maintain the credibility that they've gained in terms of inflation fighting over the years. And that just might prompt them to postpone an interest rate cut till later in this year.
And just coming back to your view on equities, as you said, there is potential in South African equities. If you look across the sectors, industrials, financials, resources, particularly are you favouring one sector over another, or is it more a case of stock picking in the current environment to extricate value?
We would think if we look at the sectors that probably the ones that are better priced would be the financials and the industrials locally, and they would benefit more from a local domestic demand-led type economic recovery that we are probably going to see over the next 18 months.